Everyone. It's nice to welcome everyone here tonight. For those of you who don't know me, my name's Elizabeth, and I'm a member of the Project Neutral Steering Committee. So a few years ago, I graduated from University of Guelph with an accounting degree. And usually when you tell people that you graduated with an accounting degree, they say, well, can you do my taxes? And I'm like, well, I'm not that type of accountant. I'm actually an analyst. And then they say, oh, he must be so good with money. Can you help me with my finances? And I'm like, well, I could barely do my own investing. And it's kind of awkward to say because on a day to day, I can help my company budget, plan, forecast their own revenue. But why is it so hard to plan and budget when it comes to my own finances? Can it be the anxiety about not fully understanding investing? Or maybe it's just a procrastination. But with the constant changes in climate and the housing crisis continues, it's time to stop procrastinating and have the money conversation. All this to say, I'm happy to welcome Tim Nash from Good Investing. He created Good Investing as a way to help people learn the basics of sustainable investing and to make intentional decisions when it comes to their portfolio. Also, he has a podcast on Toronto Star. I've been listening to it this week. It's about 20 minutes and it's good. It's a good way to start your morning. So I would love to welcome Tim Nash from Good Investing.
Amazing. Thank you so much. Honored to be here. Thank you, Elizabeth. Katie, thank you so much. We go way back and, I've been following your work and just, yeah, it's just so awesome to be here. All right, so I'm going to go ahead and share my screen. Here we go. Okay. How does that look? Can I get a thumbs up? You see my slide? Yes. Okay, fantastic. Looks good, sounds good. If there's any issues, just please let me know. But yeah, I'm just so happy to be here tonight. Thank you so much, Katie, for that land acknowledgement. Really do appreciate that. Also want to acknowledge, like, I'm here in Toronto. I live a few blocks away from Allen Gardens, where there is a pretty large encampment. A lot of people are struggling right now, and I recognize that it can feel a little bit crass talking about money while there are so many people struggling right now. And so really want to acknowledge that. That said, I do think that with sort of privilege and wealth does come some responsibility. So really want to be able to help people understand that money can be a really powerful way to be able to create change. So I'm really excited to have everyone. Just can't tell you how honored I am that you would spend a Tuesday night with me, talking about this stuff, learn about this stuff. It just means the world to me that you're here with us tonight. I want to start with investing. We talk a lot about pies, and there are a lot of pie charts. I like to start with a cake chart. Okay, so this is kind of my big picture overview. This is how I think about the economy. This is an image from 1982. A mentor of mine, the late great Hazel Henderson, she passed away about a year and a half ago, but she absolutely had a huge influence on my life and the way that I view the economy. And I just think this model is such a cool way of articulating what the economy is and how it works. So it's kind of like a cake. I always like to start at the bottom layer of the cake, this dark chocolate, soil rich layer that is Mother Nature. And I want to be clear that none of the economy, no economy would exist without nature, right? Without food, without water, without fresh air, we got nothing. So it always starts with understanding that Mother Nature really is that base layer of the economic cake. On top of that, we have the love economy. And the love economy is all of the unpaid labor that takes place in our economy. How many people volunteer for an organization and volunteer your time? You put your hand up or throw it in the chat. How many people have ever babysat for kids, for nieces or nephews or grandkids? How many people have looked after an elderly family member or family member who is sick or struggling at some time? You have all participated in the love economy. This is a huge part of our society. The rest of our economy could not exist without this love economy. And so really, want to recognize what a key role this love economy plays. From there, we do have the underground economy, also known as the black market. How many people have ever bought or sold anything on Kijiji or Craigslist or Facebook Marketplace? How many people have ever, maybe bartered for something, or that we do have that lovely underground economy that does exist. And all of these layers, each of these three layers, are what we call non-monetized. That these are not included in any of our economic measures, right? We don't value Mother Nature and nature until we like kill it and extract it and put it up for sale. We don't value volunteering or the time that we spend raising kids, looking after our family, right? These things are not counted as part of any of our economic measures. That instead, when it comes to what we do measure in the economy, so these are the non-monetized part. This is, Hazel in 1982, they talked about GNP, gross national product. Now we talk about GDP, gross domestic product, right? So when it comes to measuring the economy and GDP, really the biggest layer of the cake is actually the public sector. This is all of our education, our healthcare system, our roads, all of this public infrastructure that, again, the economy couldn't exist without all of that public infrastructure. But when we talk about the economy, we're really only talking about the private sector. That this is sort of that sugar, that saccharine sweet layer that gets all of the attention when it comes to the business pages and, the TV networks. They love talking about the private sector. But I just want to be clear that this private sector could not exist without these layers of the cake. And I think it's so important that when we talk about investing, we're really only talking about this private sector. The rest of this often goes ignored. And so that's why I really like starting my talk with this analogy of the cake economy, to understand that really there is so much more to the economy than just the private sector. But of course, that's what gets all the attention. That's the part that we can invest in. So this is the part of the cake that we're going to be talking about tonight. And I really want to start this conversation by saying that today's economy is unsustainable. I get it. We cannot do this forever. We are fundamentally eroding our social and ecological systems with the way the economy exists right now. That's where we're at right now, right? That's the struggle of where we are right now. The climate is changing. We all know, I don't need to tell anyone about the record temperatures that we had last year, the polar vortex that we're experiencing right now. We understand, I think we're all here because we know that today's economy is unsustainable, right? And this is one of my favorite little cartoons from the New Yorker, that yes, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for shareholders, right? That there are a small group of people in our society that are tremendously benefiting from the erosion of people in the planet. That is the system that we are in right now. It is what it is, right? And things are bad. I don't want to like minimize that, or, it's important to talk about this stuff, that things are bad, but I'm here to tell you that investing is still important. I think it's really easy for us who are worried about climate change to kind of, pack up and say, oh, capitalism sucks. It's all terrible. And just try to, pick up our money and stuff it under the mattress, not do anything. But investing is still really important, because at the end of the day, money is our life's energy that we spend every single day, every weekday anyway. We trade our time and our energy and our effort for money. That is what we do. That is the best representation that we have in this society of our life's energy, is that we take our passions, we take our skills, we take our abilities, and we trade them for money. That is how it works in this day and age. And I'm sure so many of you make really conscious money decisions in other areas of your life, right? Like, how many of us are deliberate about how we earn money and want to earn money in a way that is aligned with our values, right? I think that's important for most of us. How many of us are conscious about how we spend that money, that we want to support local businesses, right? And we want to buy low carbon products, right? I'm wearing my nice wool hoodie here, right? From Stanfield to Nova Scotia. I'm really conscious about what businesses I support with the money that I spend. But unfortunately, a lot of us ignore that third point, that when it comes to how we invest our money, a lot of people kind of turn a blind eye, right? We sort of dig our heads in the sand. We just let someone else handle it. We're not nearly as intentional about how we invest our money as we are about how we earn our money and how we spend our money. And that's what I'm here to talk to you about tonight, that I want you to bring the same intentionality to your investments because it's important. It's important that we invest our money because every year our money loses value to inflation. And this is something I don't need to explain this one anymore. We get it now. After the last few years with inflation at the level where it's at, every single person understands this concept, right? A few years ago, I had to explain to people that inflation is a thing and you need to invest in order to keep pace with inflation. Now, I think we all understand that inflation is a very real mechanism, right? And if we don't invest our money, if we don't grow our money, that you are going to be actually losing, that your money loses value every single year as things get more expensive. So it's really important that we not only save money, but that we also invest money. I'll never forget when one of my first clients, when I started my business, this was probably about 8 or 9 years ago at this stage, but there was a woman I met. She was in her early 60s, probably about 63 years old. She was like, Tim, I'm a hippie. I always thought that the economy was just going to collapse, that it was so unsustainable. There was no way that this economy could keep going. Of course, it's unsustainable. Of course, it's going to collapse. And so she never invested her money. She kept it in checking accounts and savings accounts. Maybe she bought a GIC, right, at a very low interest rate, right? She always just assumed that the market was going to collapse. But here she was, 63 years old. She had managed to save $350,000, which is incredible. That's a huge amount of money to save. But for those of you who might be that age, you probably know that it's not enough money to be able to retire on comfortably. And so because she hadn't invested her money, she was in a position where she had been a really, really good saver, but she was going to have to work a lot longer than she wanted. She didn't have as much money to be able to spoil her kids and her grandkids as she wanted. And she was worried. She was in a constant state of sort of, concern, borderline fear, anxiety that she was going to run out of money in her old age. And so this is a story I love telling because I think it just illustrates that it's so important to put your money to work, that it's not enough to save. Saving is great. If you're good at saving, fantastic. That's a great skill to have. But it's not enough. We also have to invest that money. I want your money working as hard as you do to be able to earn and outpace inflation so that it does continue to grow so that you can have more money in retirement. Now, I've been working in the sustainable investment field for, I think it's been about 15 years, right? I'll just give you a quick background on me. I'm a CFP certified financial planner. I grew up in London, Ontario, with my dad in the investment industry. I studied economics and philosophy out at Dalhousie in Halifax. I had all these, my spidey sense was tingling as I was studying economics that I didn't really know, a lot of these models weren't sitting well with me. And it wasn't until my third year of university, I went to New Zealand and I learned about this idea of triple bottom line economics, this idea of people, planet, and profit. And, my head just exploded. All of a sudden, I was like, this is it. This is what was missing. From there, I went back to my fourth year economics program in Halifax, full of questions. My professors didn't have answers. So I graduated with my BA in economics and went to Sweden and did my master's in sustainability. This was in 2007. I did my thesis looking at the financial materiality of sustainability risks. So I looked at this idea that, that sustainability risks are actually relevant to a company's bottom line and their profitability. Graduated, came back to Toronto in July of 2008, ready to take the investment world by storm. Does anyone know what happened in October of 2008? Remember that? It was the big crash, biggest crash since the Great Depression. So, obviously, the financial industry, there were no new jobs available. Sustainability got thrown on the back burner. So that's when I started my entrepreneurial journey. I joined CSI, the Center for Social Innovation. I tried a whole bunch of different models, but I've been working in this space now for, I guess it's been about 15 years. And I keep coming across all these myths that people, when I talk about sustainable investing, there are so many different myths, but I want to focus on three of them today. The first myth that I come across, especially from people in sustainability, is this idea that investing is gambling. That a lot of people, when they think about investing, they're like, sounds risky, more like gambling. I don't want to throw all my money away. I want to be clear that's not the case. There is a part of investing that's like gambling. If if you remember the crypto market a couple years ago, like NFTs and weed stocks when those were a big thing a little while back, that there is a way there are sort of sections of the investment market that are more like gambling, but really no, that's not what we're talking about. That the way that we avoid the sort of gambling side of investing is through diversification. So just like the way to build a resilient ecosystem is through diversification, the way to build a resilient investment portfolio is through diversification. That yes, there are going to be ups and downs, right? But there are ways to invest that basically ensure that your money will never go to zero unless the whole system does collapse. If that does happen, then, but it's not really going to matter where you had invested your money. But I want to be clear that we're not talking about gambling or day trading, anything like that. We're going to talk about nice, diversified portfolios. The second myth that I always get is this idea that sustainable investing is complicated, right? That there's all this talk and a lot of different acronyms thrown around when it comes to sustainable investing. So I've done my best to simplify it as much as possible. This is kind of my slide. If you want to take a screenshot of any of my slides, this is it. If you can understand this slide, you're going to really understand sustainable investing. That really what it comes down to is there are a bunch of different approaches for sustainable investing. Sustainable investing is kind of that high level term, that banner umbrella term I use. When I first started in this industry, we called it socially responsible investing, SRI. Then it kind of evolved into responsible investing. Now I like to call it sustainable investing. And there are a whole bunch of different approaches, but really what it comes down to is there's doing less evil and there's doing more good. When it comes to doing less evil, the goal here is to earn market rates of return. So to earn what you would normally earn in the stock market, but we're gonna, do less evil. The approaches that we can use there's this acronym ESG, which stands for environmental, social, and governance issues. Has anyone heard of this term ESG before? Yeah, I'm seeing some nods. Yeah. So this is big. Again, when I started in this, no one had any idea. Most people didn't know what I was talking about. Now, a lot of people hear about ESG. When it comes to ESG, this is about looking at when we evaluate a company, an investment opportunity, that we look at their financials. But in addition to that, we're also looking at their environmental, social, and governance, data. And so that I can assess from a risk perspective whether certain companies are leaders when it comes to environmental, social, and governance issues, or whether they're laggards. And I'm not going to go into it now in the Q&A. If we want to get nerdy and dig into it, I'm happy to talk about ESG ratings. There's a whole rating system, and it's not perfect. There are some issues with it, but it's a really, really good way of understanding which companies are leaders in sustainability and which companies are laggards in sustainability. And when we do ESG investing, obviously we want to invest more of our money in the leaders and less of our money in the laggards. The second approach when it comes to doing less evil is this idea of divestment. This was popular, really popularized with the South Africa apartheid movement when people wanted to divest from South Africa, was a huge, huge driver for ending apartheid in South Africa, was people pulling their money out of South Africa and not investing there until they changed. Later, we saw a lot of divestment from tobacco, especially a lot of doctors and medical associations were like, hey, I don't want to put my money into tobacco. Now, this is a really, really popular strategy for people who want to completely avoid fossil fuels. So divestment from fossil fuels is a way of saying not one penny of my money goes into fossil fuels. The third approach is called shareholder engagement. Sometimes we use the term stewardship. This is a different approach when it comes to doing less evil investing. This is the strategy where we're actually going to own shares in the company. But when we're shareholders, we're owners in that company. We're going to use our rights as shareholders to push companies in the right direction. So we're going to actually own companies. For example, we might own companies in a fossil fuel company, but push them for better disclosure and for more investments in renewable energy, and trying to kind of, have a seat at the table. With divestment, we're sort of taking our ball and leaving. We're saying, nope, you don't get my money at all. I don't want to invest $1 in you. Whereas with shareholder engagement, we're saying, you know what, I'm going to own shares in your company, but I'm going to use my power as a shareholder to push you in the right direction. All of these approaches, right? They're different. We can use them together. They're very complementary. It's not one or the other. Most sustainable investors use some version of all three. Everyone's going to have a different idea of their sort of change theory, right? How they want to do less evil with their investments. But these are all really, really cool ways that we can impact our investments without sacrificing financial returns. That really the goal here is to earn the same financial returns as you would otherwise, but move companies in the right direction. The doing more good side of the equation is, to me, a little bit more exciting. This is where we carve out part of our money. I don't want you to put all of your money into these doing more good approaches. We want to carve out part of our portfolio for things like impact investing. Impact investing is where we invest in things like community bonds or green bonds, where we are loaning money to nonprofits and co-ops. The goal here isn't to get rich and maximize financial returns. Instead, the goal here is to have that positive impact. So impact investing, some great examples of this are going to be community bonds. How many people, does anyone know the Center for Social Innovation here in Toronto? This is an awesome building. It's for, they actually own 2 buildings here in Toronto. How does a nonprofit own 2 buildings in downtown Toronto? They used community bonds. They raise money from the community so that the nonprofit could buy that real estate. We're seeing a lot of action in this impact investment space with community bonds in affordable housing. We all know that we're in a housing crisis right now, that we need more affordable housing. But how the heck do we build nonprofit and co-op housing? Community bonds are an incredible solution for that. Another approach we can use is thematic investing. This is investing in green themes. So we can carve out part of your portfolio to invest in things like renewable energy, clean technology, water infrastructure. There are a bunch of really, really cool investment funds that are focused on doing more good. Now, that said, these things are a little more volatile. They're a little bit riskier, which is why, I say most of your money should probably be in this doing less evil bucket. But if we're worried about climate change and we think that, hey, the economy is about to transform, we might want to allocate part of our portfolio to these solutions, right? So this is investing in more in the solutions to these problems. The last approach for doing more good is angel investing. This is like the riskiest thing on here. So again, you only want to do it with part of your portfolio, but angel investing is investing in startups. That there are some amazing small companies in Canada that need investment in order to grow and scale. And so again, this is the idea of carving out part of your portfolio for these higher risk investments, but companies that are really directly aligned with your values, right? Where if you can especially be an early investor, right, you can have a huge amount of impact with your investments. So again, these are the different approaches that sustainable investors can use. My job, what I help people do, is understand these different approaches based on where they are in their life, where they are on their investment journey. How can we bring in these approaches to your investment portfolio to still earn market rates of return and still beat inflation, right? So that your money is working for you and growing, but doing it in a way that is more aligned with your values, and that is using these different change theories to be able to actually like create the world that you want to retire into. Or if you're saving for your kids' education, you know, create the economy that you want your kids to graduate into. So I know that when it comes to sustainable investing, there's a lot of talk. It can come across as very confusing and overwhelming. And hey, what do we do? I'm here to say it's not that hard. It's not that hard. Really, it's about understanding, you know, what is your change theory? What is the change you want to see in the world? And then there are some really, really great options to be able to align your investments with that change theory. And do it in a way where you're not sacrificing financial returns. This is the number one pet peeve that I have, is that as soon as I start talking about sustainable investing, I always get that person that's like, oh yeah, but you know, go woke, stay broke, you know, who thinks you have to sacrifice returns in order to invest sustainably. And I'm here to tell you that's not the case. That sustainable investments have done just as well as traditional investments, just as well. Very similar returns. And again, I'm not going to get into it now, but what we can do is you know, in the Q&A, if you want to get a little bit nerdy, I can like go on Yahoo Finance and show you charts, and I can prove this, that the sustainable investments have done just as well as traditional investments. Some years they're a little bit higher, some years they're a little bit lower. Now, some of the investments will have lower returns, like those community bonds. We are getting a lower return. Like I own a community bond. I invested in CSI, Center for Social Innovation. I do get a slightly lower return than I would otherwise. It's not really that I get a lower return. It's more that I'm taking more risk than I would otherwise. I could get that same return with a lower risk investment, right? So sometimes there are these sacrifices, but by and large, as long as you're being smart about it, right? Really, that sustainable investments have done just about the same, especially in that doing less evil category. Really, the performance has been almost identical to traditional investments. And if you have questions about this and you want to get into it in the Q&A, I'm happy to share my screen and I can show you the charts and the data to show you that sustainable investments have very, very similar returns, right? So now we get to the action-oriented part. That's really what you need to know about sustainable investing, that we're not gambling. This isn't, you know, we're not gambling with your money here. We're making very smart investment decisions. It's not that hard. It really isn't that complicated. And I'll get to that in a minute, that oftentimes it's like as easy as like ticking a box to implement some of those doing less evil approaches. And the returns are almost identical, right? So with that in mind, here are some actions that if you want to start aligning your money with your values, these are 3 actions that you can take today. The first action is to join a credit union. I love credit unions. Credit unions offer the exact same services as the big banks, but they are way more community focused, right? So I use a credit union for my banking, my checking and savings accounts, right? And the reason I do this is because the big banks, as we know, are some of the biggest financiers of fossil fuels, especially the Canadian banks are terrible. There was a report, Banking on Climate Chaos, and it showed that the Canadian banks are some of the biggest financiers of fossil fuels in the world. And there's an amazing report that just got released by Project Drawdown. Do people know Drawdown? This is like Paul Hawken, Project Drawdown. It's like one of my favorite organizations. And they came out with this report called Saving for the Planet, the Climate Power of Personal Banking. Now, it was in a US context, but I think the same thing applies here in Canada, maybe even more so because the Canadian banks are such heavy investors in fossil fuels. But that for every $1,000 that a person has in savings, so these are deposits at your bank, so in a checking or savings account, that every $1,000 is roughly equivalent to the direct emissions generated by flying from New York to Seattle every single year. It's massive. People don't realize the climate impact of their deposits, of the money that's just sitting inside of your checking and savings account. That the banks take that money and they loan it to fossil fuel companies. We know that this is what they do. And it's not just the $1,000. There's actually a multiplier effect where for every $1,000 that you have in deposits at the bank, that bank gets to loan out $19,000 in loans. This is called fractional reserve banking. I won't get too deep into the weeds on this, but all you need to know is that every $1,000 that you keep in the bank is able to create $19,000 worth of loans. And we know that for the Canadian banks, a huge chunk of that is going towards fossil fuels and pipelines. That this is the chart that they had, that they looked at if you had, $8,000 in your checking or savings account. I think a lot of us just, like to keep afloat in your checking or savings, right? You like to keep some money in there, right? That by moving that from a carbon intensive bank to a climate responsible bank, right, is 2 times the direct emissions reductions of adopting a vegetarian diet. It's incredible. It's incredible. Now, it's not a silver bullet. Obviously, I want you to switch to residential solar. I want you to switch to an electric vehicle, or better yet, ride a bicycle. I want you to adopt, a vegan or vegetarian diet. I want you to travel locally and explore our wonderful local tourist places. But if you're already doing all those things and you're still doing your banking with one of the big banks, I'm here to tell you, you can make a huge impact by switching to a credit union. Second action that you can start taking right away is just simply asking, where's my money? Where's, right? Most people, like I said, we kind of like put on the blinders when it comes to our investments. Simply have a conversation with your investment advisor. That basically now at this, back in the day when I started, there weren't that many options available. They were sort of few and far between. Now every single financial institution has sustainable investment options. Every single bank, every single credit union, everyone has these options available. And so it might be as easy as like clicking a button or like sending an email to your advisor and saying, hey, I want to switch into responsible investments. I want to switch into sustainable investments. Can you help me do that? It might be that easy. And they can just be like, yep, we'll switch you over. You'll get roughly the same returns. No problem. It's done. That said, I am a bit of a nerd, right? So my preference is that people learn how to do it yourself investing. I know it seems complicated and scary, the idea of investing. Lizzie, trust me, right? You can do it. I know you've got the skills. Just with a little bit of learning, you can totally take control of your investments, right? And so if you talk to your investment person and they kind of hum and haw, or they kind of like, oh, really? You wanna go woke? Oh, what's this all about? If they give you a hard time about it, let me know, talk to me. There's so many options. You don't have to DIY invest. We can totally like shop around and find you a more sustainable advisor, someone to do it for you. That's like super easy. But really the idea here is that there's so many options available. Every institution has them. It might be as easy as like ticking a box online or sending an email to your advisor saying, hey, I want to switch to sustainable investments. If you're having a hard time with it, that might be a good time to shop around. That might be a good a time to consider DIY investing if you do want to take control of things in a more intentional way. The third step that you can take today is just start learning more, right? That again, most people just haven't really thought about this stuff. So what I want you to do is just start thinking about this stuff, start learning a little bit more. The work that I do, I've got my business at Good Investing. I do one-on-one financial planning. Everybody gets a free consultation. So you can go to my website, goodinvesting.com, and I have a little free consultation button. And you can sit down and chat with me for half an hour. If you want to work with me one-on-one, we can absolutely help you come up with a sustainable investment plan. I also do offer a course. So I'm running a cohort in February. So if you're interested in learning a little bit more, I have this foundations course where you learn the basics of investing and the basics of sustainable investing. And my goal is to help you build this foundation of knowledge and to get you to the point where you can actually decide, do I want to DIY invest? Or do I want to find an advisor that aligns with my values that's, have someone else invest my money for me, right? Either option is fine. But to me, having a little bit of knowledge when it comes to investing is going to go so far, both in terms of securing your financial future, but also in terms of assuring that your investments are aligned with your values. Um, I had the podcast with the Toronto Star. We did 2 seasons. Unfortunately, the Stars kind of ghosted me on a third season. I haven't heard back from them, so I don't know if I'm going to be doing a third season. That's why I'm going to be putting more and more of my efforts into my YouTube channel. So, really would love for people to sign up to my newsletter. If you go to goodinvesting.com, you can sign up for my newsletter, or if you go on YouTube, you can search for Good Investing. I'll be posting all of my upcoming webinars up there. I'm just planning a webinar that I'm going to do next week, really focused on this topic of impact investing. And so the question is how to start impact investing. And I'm going to be going through how to approach this for the first time. And I'm going to be talking to this really cool organization called Go Parity. And Go Parity is an impact investment platform that is currently doing this awesome raise to help an Indigenous community shift to renewable energy. So get them off of fossil fuel generators and into renewable energy, that this is an investment opportunity. You can, learn about that. But really, I think before people do that impact investing, I really want them to feel comfortable and to make sure that, they've got the knowledge to understand, how do I start impact investing? And that, I'm going to be doing the webinar live next week, but I'll also put the video up on my YouTube channel. So please, by all means, follow my work, start learning more about this, start thinking about this, start asking questions. The fact that you're here is just so awesome. So just really want to implore you to kind of go on a little bit of a learning journey. It's not going to take you that long, but even just like a couple of hours of learning about sustainable investments can have such a big impact for your financial future, but also for your impact on the planet. I wanted to leave lots of time for Q&A, and I think I'm good for timing there. So I imagine there are some questions. Lizzie, I'd love for you. I don't know if they were in the chat or if they're on the site, for people to ask questions, but, really hoping that we can get into it. But before we do that, just want to leave you with my final thoughts that number one, I just want to reiterate that investing is important, that it's important for you and your family. Like these are some of the biggest financial decisions that you make. So please bring that same intentionality that you bring with other financial decisions, bring that to your investments, and that you need to be thoughtful about your investments. That if you're going to invest, which you should, right? You want to stay on top of inflation, you should be investing. If you are going to invest, invest sustainably, that the trade-offs are way lower than people realize. It's way easier than people realize. I know it seems daunting and a little bit scary, but I'm here to help you through it. The last point is that, when I meet people and I talk to them about their money, so often when it comes to their emotions around money, the biggest emotions are about guilt and are about shame, and that, oh, I wish I had done this so long ago. I can't tell you how many of my free consultations people are like, damn, I should have started doing this so long ago. And I'm always here to remind them that the best time to plant a tree was 30 years ago. The second best time to plant a tree is today. That accept those emotions that you have around your money, but don't let those stop you. Don't let those be a barrier. Accept them and move through those options and start planting a tree today. That by taking this seriously and giving it some good thought, you absolutely can benefit yourself and your family, but also your society and also the planet. These things are so interconnected, right? So really, the second best time to plant a tree is today. So that's it. That's all I've got. I'm hoping we can get into a Q&A. I can get as nerdy as you want. I did my best to avoid like the pie charts and the graphs and the, going too deep into things, but like, I'm so happy to go there if people really want to. My email is tim@goodinvesting.com. I'd love to hear from you. If I can help you in any way, know that I'm here. But otherwise, I'm going to stop sharing. And Lizzie, I hope we've got some questions.
Yes, we actually got a lot. Thanks, Tim.
Yes.
That was super good. Fun fact, actually, during university, I worked at a credit union as my part-time job.
No way. Which credit union?
Yeah, so Duca. I'm not sure if
Duca.
they're that sustainable, but yeah.
They are. I'm a member of Duca. I know a lot about Duca. This is the
Yes.
Dutch credit union here in Toronto, and they're a B Corp. And there
Oh,
are
okay.
only a small number of credit unions that are B Corps, and Duca is one of them. And they have this really
Nice.
cool thing called the Impact Lab that, I've been kind of following their work. So I am not only a fan of Duca, I'm also a member.
Oh, okay. I'm proud to say I worked at Duca Bank, so it's always just like a little piece of history.
I love it. I love it.
Okay, so we have a few questions. The first one's kind of a question, kind of a statement, but it
Sure.
goes, when I look at the holdings of ESG ETFs, there are a
Yes.
ton of banks, and I know
Yeah.
banks are huge supporters of the fossil fuel industry. Fun,
Yeah.
frustrating.
Yeah. Yeah. Okay. So this is great. So again, this is where it's really important to understand that. So for those, I just want to kind of break down the acronym. So ESG, environmental social governance. So again, this is a doing less evil fund, and an ETF is an exchange traded fund. Okay. So this is a fund with lots and lots of companies inside of it. Most of us invest in mutual funds. And the same thing is true if you look at sort of sustainable mutual funds, you'll often see the banks in there as well. In this case, it's someone who's doing ETFs, exchange traded funds that we buy online, which I love ETFs. I'm such a huge fan. So yeah, so that's a big concern. It's important to understand that again, these different approaches. So divestment is an approach, right? If you're saying I don't want one penny to go towards the Canadian banks, then we need to divest from the banks. We want to find a fund that has absolutely zero. That said, most of the doing less evil ETFs on the market, they don't divest from banks. Even the ones that divest from fossil fuels, they have what's called a revenue threshold. So if a company earns more than, it's usually like 10% of their revenues from fossil fuels, then it gets excluded. With banks, even though they're huge lenders to fossil fuels, it's not 10% of their revenues. So they kind of sneak through the screen. Banks have also been really, really good at kind of playing the ESG game. So again, I don't want to overwhelm with acronyms too much, but for those of us in the industry, when I started, it was all about CSR, corporate social responsibility, right? It was more of a marketing thing. And you better believe the banks were all over that, right? Like they just absolutely had big departments that did communications and were all about corporate social responsibility. Nowadays, it's about ESG, environmental social governance, and that banks have teams of people dedicated to getting good ESG scores, to understanding how the scores work, how do we improve our score, how do we get a good score. What this means is that the banks are really good at kind of gaming the system and having a good ESG score, which means that when we open up some of these funds, banks are almost always at the top of it. There are ways around it. So I have a lot of clients who just don't want to own the banks at all. I got to say, RBC is kind of at the top of the list in terms of, most hated companies in fossil fuel circles. So there are absolutely ways around it. I do have some resources on my website. So for example, I've got model portfolios, and in my crunchy granola portfolio is what I call it, my crunchy granola pie. There are no there are no banks, Canadian banks in there at all. So we totally can get rid of it, but you got to understand that these things, it's never going to be perfect when it comes to this. There's no such thing as a perfectly sustainable portfolio. If we do want to avoid the banks, we totally can. But I want to be clear that even by investing in that ESG ETF, even if it's got banks in there that you don't love, I want you to rest assured knowing that number one, that they are playing that ESG game, that we are pushing them on disclosure and performance, that there's a lot of pressure on the banks, and that also the shareholder engagement. That by investing in these ESG funds, at least your shares are going to vote to be pushing those banks in a more sustainable direction. So if you want to completely avoid the banks, like talk to me, we can do it. I have my tricks. I know how to do it and still, but it is a pretty big part of the Canadian stock market that in a lot of these standard funds, we might kind of like hold our nose and invest in the banks knowing that we're getting rid of the fossil fuel companies and that we're owning the shares and pushing them in the right direction.
Interesting. Okay. That,
Yeah.
yeah, that's, I guess doing a little bit of good is sometimes better than not investing at all, you know?
This is where it gets tricky, right? Like it's not perfect. So I always say we do the best we can given the options that are available. But when it comes to these like specific things where people are like, and unfortunately the banks is one of them where there aren't a lot of products that avoid them. I do have my lists and my way around that, but there's always going to be a question of, what are the trade-offs involved in doing that?
Hmm. Okay, so I guess we can move on to the next question. How can I set up a community bond for a cause I believe in?
Ooh. Okay, so I mean, when it comes to community bonds, so I want to be clear that community bonds are really, really good when it comes to buying or building assets. Okay. So a community bond is not going to be useful if you want to start a nonprofit to run programming and you need like startup money for salaries and for office expenses. No, no, no. Right? A community bond is going to be really useful. Debt, because it's debt. You're borrowing that money from investors. It's really, really good when it comes to buying an asset that you can then use to generate profit. So, for example, the oldest community bond in Ontario is Solar Share. Has anyone ever heard of Solar Share, solar bonds? I see a couple nods. Yeah. So, solar bonds are super cool. They borrowed money from investors to build community owned solar projects in Ontario back when we had the FIT program before it got canceled. Right. So, but that, solar panels are a great use of community bonds because you're borrowing money, you're building a solar project, you're generating energy that produces energy, you sell that to the grid, you get money, and you can use that money to pay back bondholders. Or for property, because again, something like the Center for Social Innovation or affordable housing, we're building an asset, we're buying a building, we're then renting that out to generate revenue that we can use to pay back the bondholders. So I want to be clear, first of all, that really community bonds and debt in general is really, really good for nonprofits who want to buy assets or build assets. If you're interested in doing that, if you have a nonprofit, there are a lot of these like community land trusts and groups like this that really could benefit from purchasing assets and need money to do so. The organization you want to connect with is called Tapestry Community Capital. Tapestry Community Capital, they are like the leaders when it comes to helping nonprofits issue community bonds. So Tapestry Community Capital, talk to them. They are going to want to like talk to you about your financials and understand. And they're going to be like, so you're going to like, you're buying an asset, right? Like you're going to buy a building and you have a way of generating revenue, right? Because we do need to pay back those bondholders. But they help nonprofits get ready and go through the legal and the accounting and the administration for those community bonds.
Okay, thanks for clarifying because I definitely thought the first one as well. I'm like, oh, I could start a not-for-profit.
It's not for startup capital. Like that's, and it's tough with the nonprofits, but that's more like angel investing,
Hmm.
right? Which again is a lot riskier and like it's just tricky. Bonds, because bonds are debt, are really good if you're already an existing organization that wants to buy or build, a building or a project or something that is going to then generate revenue so that you can pay back the bondholders.
Okay. Okay, so the next question, a few people voted on, it says, how would a shareholder engagement actually go down for the average person like us or people like us?
Ooh. Yeah, so I love it. So, okay, when it comes to shareholder advocacy, so I want to be clear, like no one's actually expecting you to show up at the meeting and vote. Some people do it. Like I've had clients that will like buy like shares of RBC so they can like show up at the meeting and cause a ruckus, right? Like this has some people do that. I don't expect people to take it that far. Okay. Instead, the way it works is that most of these sustainable investment funds, whether it's a mutual fund or whether it's an ETF, they have something called proxy voting guidelines, meaning that they will vote their shares for you. And what you want to do is to put your money in a fund that has proxy voting guidelines that are aligned with your values, that are going to vote for measures related to diversity, equity, inclusion, climate change, paying employees a living wage, limiting CEO salary, or tying executive compensation to sustainability metrics. Like these are all issues that that sustainable investors want to make sure that we are voting our shares in favor of those measures. So again, this is really like the tick box exercise that by investing in a sustainable fund, right? You can just ask them, do you have proxy voting guidelines? And if it's like, yeah, then again, this is a way, it's still the same. You're still investing in the same companies. It's still the same financial return, but the default setting for most funds by default is always to vote with management. So if the management says, well, we don't want to do DEI, or we don't want to do climate reporting, or we don't want to do, executive compensation tied to sustainability, then by default, most shareholders are voting against that motion. So by simply investing in a sustainable mutual fund or ETF that does have proxy voting guidelines that are aligned with your values, it's just like it's an automatic thing. You don't have to take any further action. This is why I say it can be as easy as like ticking that box kind of thing, that if there is a sustainable version of the product that you've got, then right away, it's like that box is ticked and your shares are now pushing that company's in a more sustainable direction.
Okay. So this proxy voting it's only a one-time thing that you have to do. So you don't like every meeting they kind of like,
It's not even a one-time thing that you have to do. It's like literally the default setting for your
oh,
fund.
okay.
And the default setting for most funds is to vote with management, whereas the default setting for sustainable funds is to vote for sustainability measures.
Okay.
So simply by switching from the traditional fund into the sustainable fund, it's going to happen automatically for you.
Okay. So it's easy.
Yeah, super easy.
Perfect. Okay, so the next question is, could you give examples of sustainable investments that one can make today?
Ooh, yeah, absolutely. So here, why don't I share my screen? If I can do this and then get rid of here. There we go. Okay. So there are so many examples on my website now. Again, I'm a little bit more focused on DIY investors. Okay. So that's where a lot of my research is. So my website, goodinvesting.com, I've got these free resources and I've got my lists. Okay. Now these are ETFs, these exchange traded funds. So there are also like mutual funds. If you want to go through an advisor, you will be paying higher fees, but this is my list. These are the all-in-one sustainable ETFs. So we've got like the BMO Balanced ESG ETF. This is the iShares ESG Growth or the ESG Balanced, the ESG Conservative portfolio. These are all different options. I know I've got a little glossary here. So they each have a little like ticker symbol. So don't get thrown off by that, but that's just like a 3 or 4 letter symbol that's unique to that ETF. Here I have the MER, which is the management expense ratio, which is the annual fee. This is like one of the biggest things in terms of understanding how much you're paying. Understanding this acronym MER, management expense ratio. If anyone has seen these like commercials by Questrade where they're like, you can save 30%, like retire earlier by lowering your management fees. This is what they're talking about. So, this is code word MER for annual fees. So I always kind of put the cheapest ones at the top. Then I have ESG risk, which is the ESG risk rating from Morningstar, right? So a lower score here is better, right? It means, less risk. From there, I have carbon intensity, which is the tons of CO2 emissions per $1 million in sales. So again, a lower number is better here. And then the last one I have is fossil fuel revenues, because I know so many of my clients and people do want to divest from fossil fuels. So these are like all in one sustainable ETF. So these are going to be a mix of stocks and bonds all inside of one. I don't want to get too deep into like, portfolio theory, but like these are really nice all in ones where these are all going to be doing less evil options. But I do have other lists here. I have my global stocks. So this is a list of all the global stocks, right? So I can show you here. For example, this one, the Horizons Global Sustainability Leaders, is the one that doesn't have any banks in it. So whoever asked that question, if you really want to avoid RBC, this is the type of option that we could talk about, but it is a little bit more expensive, right? But you can see the fossil fuel revenues are 0 on it and the carbon intensity is very low, right? But I also have other lists for bonds. and then doing more good stock ETFs. So these are like the themes. So if you want to invest in clean energy, or this is like global sustainable, these are clean tech companies. This is a water fund. But you do have to be careful with these clean energy ones. A lot of them have really high carbon intensity and fossil fuels inside of them. Like this one is like 12.3%. It's like global climate opportunities, but it's got 12% fossil fuels inside of it. So, don't get me started. This is the whole greenwashing. This is why I'm like, talk to me. I can help you sort of navigate this stuff to figure out the ones that are right for you. And then the one that I get the most excited about are the impact investments. This is the doing more good side of the equation. These are the community bonds. This is where things like, oh my goodness, I love this stuff. Fair Finance Fund. This is to invest in sustainable food. So these are organizations that are, farms and food trucks and markets and co-ops, and like it's just such a cool organization here. I've got like renewable energy. This is an affordable housing. GIC. This is Habitat for Humanity. A lot of people probably know about Habitat for Humanity. 10 Carden Street. This is a co-working space in Guelph, Ontario. Like this is the really like crunchy granola stuff for people in Ottawa, greening sacred spaces. This helps churches and temples and mosques retrofit and lower their energy consumption. Really, really, really cool options. So again, it can get a little bit complicated. I don't want to get, like there's a lot of stuff here. I don't want people to feel overwhelmed with it. But if you are looking at like specific options, especially if you're a little bit more on the DIY side, then, my free resources tab can be really, really useful. If you want someone to manage it for you, if you're like, Tim, DIY investing, I don't want to do that. I want to like hire someone to do it for me. Then again, there are lots of different options. Sign up for a free consultation with me. I can talk you through. One of the organizations that I have a very good relationship with is called Genus Capital Management, GENUS. They manage money for the David Suzuki Foundation and for Greenpeace Canada. And they're a full service manager, but they do have like minimum investment amounts. Like you have to, I think, invest at least 100K. And there are some things. That's why I say like talk to me first. If you want someone to do it for you, that's fine. Talk to me. I can help you basically shop around for a new advisor to help you align it with your values. Is that helpful? I hope it wasn't too much. I'm always nervous about like, I want to show practical examples, but I don't want to like get people's heads spinning on this.
No, it's a good resource to start if you just even want to like look into a few of those yourself.
Yeah.
So thanks. The next one is, are all credit unions climate responsible?
Woo! Uh, for the most part, yes. I mean, really the way it works is that by default, so the difference between a bank and a credit union, I want to be clear, they all offer the same services. Okay. So it's like same. They also offer the same insurance protection. So your deposits are just as safe at a credit union as at a bank. The difference is that banks are privately owned, meaning that they are publicly traded companies. You own shares, that the goal of the bank is to maximize profits for shareholders. That is the ultimate goal of a bank, maximize profits for shareholders. Credit unions are much more local, that they're co-ops. So the co-op structure is that their goal isn't to maximize profits for shareholders, it's to maximize benefits for members. So I see someone in the chat, my experience, same services, no fees, like at Duca, like I don't pay a monthly fee, right? It's cheaper than a bank would be because they're not trying to maximize profits. Now, the way it works is that banks by default, have these corporate clients that they do the deposits, but they also do corporate financing and project financing. So they're, financing pipelines and oil sands and mining projects, right? That's what they do. But credit unions, no big corporation is going to do their banking at credit unions. So credit unions by default, the loans that they do are mortgages and small business loans. Now, I'm sure there are credit unions in Alberta that have fossil fuel small businesses as clients and members, that they would do loans to small businesses. That would be their community, that would be their membership. But here, certainly here in Ontario and in most provinces, really by default, credit unions are absolutely going to be way more climate conscious. They're not going to be making loans to large corporations or to these major fossil fuel projects, right? But we don't have reporting, so I can't say for sure that they are fossil fuel free, that they never loan to any, that they'll won't have a member that's like involved in fossil fuels. I can't promise that because the reporting isn't to that level of detail. There was one credit union in Kitchener-Waterloo, Kindred Credit Union. They used to be the Mennonite Savings and Credit Union, but they actually did a review and got like certified. It's like, but they're the only one that I've heard of that's ever had their loan portfolio reviewed in that manner. So, to me, it's I can't like promise with 100% certainty that every single credit union is going to be climate conscious. That said, just by understanding the different business models and the governance structures, right? That I can promise you that credit unions are way more democratic because instead of one share, one vote, it's one member, one vote. Everyone gets the same vote. And that their line of business is such that they're really going to be doing mortgages and small business loans to people within their community rather than the banks. Their business model is doing large scale project finance to large corporations. Does that make sense?
Yeah, it does. Okay, so I guess we'll move on to the next question because I think there's a few more. Um,
Amazing. I
there's
love it.
quite a few, so
Okay,
hopefully.
I'll do lightning round. I'll do as quick as I
No, it's
can,
okay. It's
but
okay.
good for time. Okay, great.
So, okay, maybe it's not that. Okay, so what are the risks level of what are the risk level for community bonds? How do you
Ooh,
invest in them?
ooh, you got to come to my webinar next week because that's what it's all about. So, basically when it comes to community bonds, there are three big risks that you want to consider. Okay. Risk number one is what we call liquidity risk. The community bonds, you're typically locked in for a set period of time. So it'll be a 3-year term or a 5-year term, and you're locked in. You can't get that money out if you need it sooner, right? So liquidity risk, this is like a big deal. This is why, like, don't invest. If you're planning, you might need this money in the next few years. Don't invest in community bonds. So liquidity risk is number one. Number two is what we call duration risk. So that these bonds pay a fixed interest rate. It's kind of like having a fixed rate on your mortgage for that whole duration, right? And so, it's the type of thing where interest rates are going to fluctuate over that 3-year term or 5-year term, right? So people who bought a community bond, 3 years ago when interest rates were low, maybe like I bought a community bond for a nonprofit in Toronto called Sketch. Sketch does arts programming for youth experiencing homelessness here in Toronto. They bought their building on Shaw Street. It's an incredible nonprofit. Instead of paying rent every month, they now own their space, which is amazing. So
Um,
Sketch is super awesome. But I'm only earning like 3, maybe 3.5% on that bond. And at that time, like 3% was pretty good, right? When interest rates were low. But now interest rates have gone up. So
mhm.
now that's the duration risk that now if I invest in them, I could get a higher return elsewhere, right? So that's the duration risk that if interest rates do go up, well, you're locked in at that, fixed interest rate for that duration. So there's a risk there. The final risk is the big one, probably what the person was really asking about, which is what we call default risk. So anytime we buy a bond is a loan. We're loaning money to a nonprofit or a co-op. So the question is, what happens if they go bankrupt?
That's
And
what
this is where every single investment is different. So I can't give a blanket statement on this because everyone's different. So each community bond is going to have its own default risk. We really do need to evaluate them one by one. For something like CSI, the Center for Social Innovation, they have the asset. Remember how I said bonds are really good for if you're building an asset? Right? So in the case of CSI, it's the building. The building is the asset. So if CSI went bankrupt, they would have to sell the asset. That's what happens when there's a bankruptcy, right? Is that you go through and you sell the assets. Now, maybe the value of the asset has gone down and it's a fire sale because they went bankrupt, so they have to sell it, and so they sell it at a loss. There might not be enough money from selling the building to cover all of their bond holders. This is where the expression we use as bondholders would take a haircut, where you wouldn't get all of your money back. Now, hopefully, it's just a little trim. You get like 80% of your money back. Worst case scenario is it's a buzz cut and you're losing most of your money. You know what I mean? So this is why, really what you want to do is before you invest in a community bond is you want to ask them point blank, what happens if you go bankrupt? And they're going to have an answer for you. And it's usually going to be like, well, we have these assets. And so we're going to sell these assets. And depending on, the price that we get for those assets, we're going to start by paying back the mortgage holder, and bondholders are going to line up, and you can figure out where you are in line. And that's the risk that you're taking by investing in a bond, is that if they do go bankrupt, you might not lose some, or in a worst case scenario, you would lose all of your money. But each bond is going to be so unique. But this is why when we said before, like a nonprofit starting, I don't want to loan money to someone if it's going to salaries and rent, right? Because if they go bankrupt, it's all gone. Instead, I want to loan to a nonprofit that's building or buying an asset such that if they do go bankrupt, they have that asset, they'll sell that asset. I'm pretty confident I'll at least get part of my money back, if not the whole thing.
Okay. Well, that's why you don't put all your eggs in like one basket as
And that's
well.
why diversification, and only, community bonds are a little riskier. So, only a small slice of the portfolio.
Okay, perfect. So we are running out of time, so I'm going to ask you guys to vote on your favorite questions, just
Get
so
in there.
we'll pick the last two because there are a few. But I'm actually going to skip over the podcast one just because you can listen to his podcast. He has a few episodes, but the next question is: I invest in GICs,
Okay.
guaranteed by
Yeah.
CDIC.
Yeah.
Those funds are then invested by banks and credit unions and mortgages. So are GICs an impactful investment for housing?
Yeah. Depends on the GIC. So, okay. So let me get through the acronyms there. GIC, Guaranteed Investment Certificate. Okay. So this is, we are locking in that we have a guaranteed investment here, zero risk. The reason it's guaranteed is because it's eligible for something called CDIC, Canadian Deposit Insurance Corporation. So this is the federal government insures GICs such that even if the bank goes bankrupt, that's okay. The federal government has your GIC backed. It's insured, so it's guaranteed. That's why the only reason I can say it's zero risk. So if we're doing a GIC through a credit union, then again, we're loaning money to that credit union. Who is the credit union loaning money to? Local businesses and mortgages within my community. If I do a GIC through my bank, I'm loaning money to the bank. Who's the bank loaning money to? Large corporations, including tar sands and pipelines. So this is, I mentioned Hazel Henderson at the start with the cake, one of my mentors. She hated this term impact investing. She's like, damn, I hate that term. She's like, every investment has an impact. The question is, what kind of impact are you having? Are you having a positive impact, or are you having a negative impact? And I would argue, based on that slide, that the drawdown study that showed the impact of your deposits at the bank, that if you're buying a bank or buying the GIC from the bank, you're having a negative impact on the climate. But if you're buying a GIC from your credit union, you're having a positive impact in your community.
Okay, that's good to know. I'm going to do two more questions. This one I'm kind of interested in as well. Can community bonds be part of an RRSP?
Oh, so, okay. The legal answer is that yes, community bonds can legally be part of an RSP. From a practical standpoint, we never do it. It's such a pain in the butt to hold community bonds inside of an RSP. You have to set it up with a separate organization. They charge an annual fee to do it. So if you're someone that has like a lot of room in your RSP, and you're investing more than like $10,000, $15,000 in a community bond, it might make sense to go through the rigmarole of getting it and buying it through an RSP. But honestly, it's such a pain in the butt, right? And most people, I don't want you putting, $10,000, $15,000. Like, you know, I only want you to put maybe like 10% of your portfolio at most in community bonds. So if you've got a portfolio you'd have to have a pretty big portfolio to justify that. So this is my way of saying is that legally, yes, community bonds can be held inside of a registered account. We used to be able to do it through all the big banks. And then I'll never forget the week. I remember Tanya Sermon from CSI. I remember stopping by her office, and there was one week where every single bank decided to stop processing community bonds inside of RSP accounts. And they just stopped doing it. And so now we can do it, but the fees are just absurd, and they put up all these roadblocks such that, usually when I'm working with clients and we do an investment plan, we carve out part of it for community bonds. My suggestion is often to just hold it outside of an RSP or a TFSA. It sucks. It means that you're paying taxes on the returns, right? But let's be real. Most of us are not buying community bonds to get rich for the investment return. We're doing it for the investment return plus the warm fuzzies.
Mhm.
So, and this is also why for most people, we might want to wait until you have your RSPs and your TFSAs, those tax-free savings accounts, those tax shelters maxed out. That's when community bonds and impact investments make a lot more sense. If you're like where I am in my investment journey, where I still have a lot of room inside of my tax shelters, right? I haven't maxed them out yet. Then that's why I generally do sort of like smaller amounts into these. I might put $1,000 or I might put $500 into a community bond, right? It's not going to be a huge part of my portfolio. And one of the reasons is because the returns are going to be considered taxable income because it's just such a pain in the butt to hold them inside of RSPs. I wish I had a better answer for that. There are a few people that are fighting to get them more, inside more RSPs. I'm tired of fighting that battle. That to me, it's just like, hey, just pay the taxes on your interest. It's not the end of the world.
Okay, so it seems like a painful process. So not for me either. Okay, so we're gonna do one last one, and
Whew.
then the rest you could book an appointment with him, and you could ask him. It's 30 minutes of
Love
consultations.
it. Thank
We're
you.
gonna do one more. How do you find companies to help as an angel investor?
Ooh, okay. So there's a really, really cool organization focused on helping everyday people figure out how to be angel investors called Spring Activator. They have a bit of a funny URL. I think it's spring.is. Yeah, spring.is. This is Spring Collective. They're a really, really cool organization. They're fairly new. They just popped up in the last, I'd say, like 3 to 5 years. But they're all about angel investors, and they actually do a course so that you can like take their course and learn how to become an angel investor. They have like a health impact challenge. I watched like their finale. They like the class went through like how to do it, and then they evaluated. And there was like a long list and then a short list that presented, and then there was like a winner at the end of that they selected, and then participants were given the opportunity to make their very first angel investment. I want to be clear that for the most part, angel investing, this is like Silicon Valley, like venture capital. This is super high risk, and often this is kind of the area where like millionaires and billionaires play. It's like these are people who you can lose all the money, but they don't care. They just want to, throw it at a whole bunch of different companies and hope that one of them becomes the next, Facebook or Google or whatever. So what I love about Spring is that they're making it way more accessible to regular everyday people. Again, as a financial planner, I really only want it to be a tiny little slice of your portfolio. This is like by far the riskiest type of investing that you can do is angel investing. But if you want to learn more about it, can't recommend Spring enough. That really, really cool focus on the educational side, and they do tend to, have a focus on the impact side. So I know they did a health one. I know they've done some social enterprise angel investment groups, but really, really cool organization here in Canada that's doing some great work.
Okay, that's good to know. Thank you. You answered all those questions. I learned so much, honestly. So thanks for coming and giving us all this advice and knowledge. Katie,